What's up, guys? Hope everyone's doing great. Today, I'm going to break down a trade that I took and made about $2,500 across, or 2419, something like that, across 18 funded accounts. Now, usually I trade 20 funded accounts, but I clicked the wrong trade copier on Trade of 8, so it was only 18. So I missed out on probably about a few hundred bucks of profit, 300 bucks, give or take. So let's jump right into the actual chart breakdown here, so everyone is on the same page. So what we see here is the NQ chart. Now, usually I always trade off New York Open, right? But today I actually did not trade off New York Open. I'll tell you why. It's because in trading, one of the key things is you need to be comfortable and confident that you are doing the process right. What does that mean? Confident in the process being correct means it's not just about taking trades whenever you want to, okay? Trading is just as important. You need to understand that you need to feel confident in what you're doing is good. So when I mean that is I had a good month last month, but when I looked at my data, I did about 64,000 or 67,000 actually in profit for the entire month of July. Now, the biggest data point that really stuck out to me was my win rate was quite low relative to the past. And I'll tell you that for a few reasons. Firstly, it was 46%. Now, why was my win rate low? It's because, candidly speaking, I wasn't going as hard on trading in the last few months, just building up ZTH. And then I was like, you know what, bro? I'm trying to go back for like 200 G's a month now on trading. So I was like, I got to strap in. So I took it really seriously last month and a half. And I came back from a long trip on Japan. My trading wasn't that good in Japan either. I was like off and on, like trading whenever I wanted. It was not really that disciplined. But long story short, that caused FOMO. Okay. And I didn't realize it until I started really analyzing the month end over the weekend. I was looking through my data and realized, man, I took a lot of FOMO trades. So what I would do sometimes, candidly speaking, is let's say I had a winning trade. My win rate got worse because of this reason. So let's say I had a winning trade, right? Let's just give an example. This is a short, right? Let's say I shorted here. I would short here, right? And the trade would be somewhere around here, right? And it would be already at about a 2R profit. But I did it small because it was not a high probability trade. And I knew it was a high probability trade. So it was maybe like like at a 50-50 shot or even less. And I was like, you know what? I'm going to go for like a 2.5R. But I broke my discipline. The moment it started breaking down, I would size into this. Happened on gold 3 times in the month last month. That was also my biggest losing days. So what ended up happening is my 2.5R trade that could have been a winner for maybe about on 20 accounts, probably like 7K US, 8K US, I was going for like 20, 30. So what I would do is I would basically see the trade right here, right? And effectively what I would do is I would dead ass size into the trade at a horrible spot, just like pure greed, pure FOMO. Like no logic to it, just pure FOMO and pure greed. And guess what? When you enter at a wrong place and it starts reversing at you and you enter with size, let's say I entered with 2 or 3 micros on gold to start, okay? Like let's say usually it was 2. And you enter with 5 micros here, guess what's going to happen when it comes back to break even point? You're in a loss now. So your dad's in a loss, you know? And I was like, fuck, this shit moved fast. And had I just stuck to my initial plan, I would have been out with like 7 Gs, 8 Gs, because you know what, that was my initial target. But ended up going here and ended up being like, okay, man, well, I still think it's going to go well, but that's the thing. I started convincing myself otherwise because I was heavily sized into it as opposed to thinking logically. And I was already down probably like the entire profit amount that I'd made was probably a minus 4K, 5K loss at this point. And then I had to ended up cutting it like right around before my initial stop because it was way above it was above my loss limit. My loss limit for the day was like 8K or 9K. Or like in some days I gave myself a bit of a more generous loss limit, like 13, 14K. But it would basically come up and before even hitting my stop loss amount that I should have had initially, it ended up coming to the halfway point, ended up cutting me out for like the biggest loss I had last month, like 17 grand. And this was exactly what happened, right? It was like dead ass stupidity. And then I was like, that's dumb. So I was like, okay, I'm not gonna do that anymore. But I didn't really see it as a problem. I kind of like left it to the side note and I was like, okay, I'll rectify it whenever it becomes a problem. Bad mindset. Whenever you see an issue in trading, rectify the mindset immediately. So I didn't do that. And then I had another day, but thankfully I never had that big of a loss anymore. And it ended up going smaller. So then my second largest loss was 10 Gs. And then my third large, quote unquote, large loss was 7K. And then after that, I was like, okay, I'm stopping that BS. And then I never had losses more than like 4K in a day, which was right within where I wanted it to be. It's about 200, 300 bucks per account. And 7K is fine, but it's just like the reasoning behind why I lost to 7K wasn't good. Like it shouldn't have happened in the first place if I was being disciplined with it. So What was the main lesson that I learned? Sizing in is one thing, but FOMO is the biggest killer. So FOMO is really the thing that got me screwed up, right? It really got me screwed up. So fear of missing out means A, there was two things I noticed in my trading of last month. A, this happened where I could have literally, guys, just imagine I made 65K in profit last month. I would have actually, I did the math on it. Had I not done this shit, I did an analysis on TradeZella, look at my data, and I was like, okay, if I would have cut it initially, I would have actually not only not made those large losses, I would have actually made a profit on those losses. So if you do the math on it, it was like 17 G's, 10 G's, and 7 G's, something like that. That's 35K. I would have actually added an extra like 41K, like 39 to 41K, just not doing stupid shit and sticking to my initial profit target, which means I would have had a 100G profit month last month. Crazy, right? Just understanding that data really it kind of like awakened me, and I calculated it over the weekend. I still had a few more days that I wanted to properly map out my data for in the morning today on Monday, so I didn't trade. I was just doing it in the mornings. I was like, I'm not in a rush. I'm just going to properly analyze everything and make sure. Second thing I learned, really make sure you milk the right setups. So milking the right setups is what I'm going to talk about today. Some of the best setups that I've learned you should be taking on a consistent basis. So milking the right setups means you have to look at your actual data and not just look at the actual setup. So one thing that a lot of beginner traders they make mistakes with is they see a setup. Let's say you have a setup that's like like a break and retest. You have an uptrend and then you have a break and retest into the level and then you continue to the upside. What a lot of beginner traders fail to see is context. Context means where is the market at overall, right? You look at, let's say, the FOMC news, you think about rate cuts. What's going on? Number one. Number two, you look at the higher time frames. More importantly, I weight this even more daily 4-hour chart. What's coming into the day? What's the narrative looking like? Then when you take a trade, let's say within the hourly, then you take a setup and it's contextually very solid. That's when you have higher win rates. And I noticed that whenever I stuck to that, I would have not only big winners, but I would be able to ride them for like 5R, 6R at sometimes, like really milk those trades, really milk those trades. So what I decided for this month, and thankfully I did it on Monday morning because I was like, you know what, I'm not going to trade until I get it done. I have to get my mind straight and I'm not going to rush it. I'm going to be disciplined about this, not because trading, it's about good decision making. Sometimes the best decision not to trade is the one that makes you the most money. Like last month, not trading would have made me an extra 30 G's on certain days, right? But not to say that you shouldn't, but it's just you get the point. You will make a lot more money by being selective than you will be by rushing into every single opportunity that you see that occurs, right? So, end of the day, what I ended up realizing was being selective is what's going to take my win rate. Not only being selective, right? Being selective is one thing. So let's say my win rate was 45% last month. Being selective on not going for C setups, right? But going only for B plus setups, anything that's B and above. And then also on top of that, not doing that size in nonsense that I was doing, that will take my effective win rate just based on math to about 59 to 60%, right? And my profit factor on TradeZella is very good. So not very good, but it's decently good. It's like my average win loss is always 2 to 1. And even that will go up, which means my average win is always 2x bigger than my average loss. And that's like data that's been accumulated over like hundreds of trades over of last month. So if you look at that, what does that tell you? It tells you everything in my statistics by being more selective would go up because whenever I win, I always hold it. And whenever I lose, I'm always disciplined. I never had like a big tilt day. So what does that tell you about my data? It basically tells you that if I focus on that singular thing by being more selective and most importantly, not sizing in like crazy for no real reason, that automatically would take, based on the data that I've done, my average win rate ratio from 2 to 1 to 3 to 1, right? And my win rate to 60%, which means I'm going to make a lot more money, right? I'm just going to make a lot more money. That's going to take me literally, it probably will not only like make me more money, like 40% difference in my actual tradable income. So trading is a business. You see how I'm looking at it like a business? That's how you have to look at trading, like a business. Now, that being said, with that in mind, let's talk about today's market structure. Okay. Now, in terms of today's market structure, by the way, these are just indicators, not even indicators, just timing based things that I'm testing. I don't really like this one that much, so I'm just going to remove it. What I like, and if you've been on a few of my sessions in the past, you'll probably realize that I do like the London high low sessions. They're the London high lows. They're good levels to take from liquidity. So when we look at the market coming into today and we do an analysis, right? Coming into last week Friday, we all notice that the market dumped really aggressively, okay, really aggressively from these highs, okay, and I actually took a trade on that. That was one of my bigger days on Thursday. That was I actually sniped it around opening print on NQ on ES, and I actually wrote it down to like there-ish. So it was good, but I already knew based on the higher time frame frameworks here, this does not look bullish. It looks very bearish. So I already knew with the strong volume close on the daily chart, with the bearish narrative coming in from the 4-hour chart, I believe we were due for a solid retracement or reversal. So for me, that was my bias coming into this week. Okay. I knew that we were going to dump. Like, moment last week, we closed on Thursday, the 31st of July. Then for me, I was like, immediately bearish is my bias moving forward. And I took a few trades actually that were in the bearish direction. And I contextually saw, based on the daily time frame, if you notice, support and resistance lines are very powerful, especially when taken from higher time frames. So my first keystone of analysis was I saw in the daily time frame a lot of these regions. These were prior areas of resistance that the market encountered around here before sharply selling off, one time here and then another time here. So this overall broad region was telling me, okay, this is an area that the market will most likely react towards to the upside. And then on top of that, if you notice here on the daily chart as well, there's a slew of market movements here that looks very similar to a flag type formation, right? So flags basically just means consolidation after a move up, right? Just consolidation. For the purposes of trading, I don't really use them to make entry signals or anything like that. I just look at them contextually speaking to understand what's going on. And if you look at it, what was I looking at? I was looking at it, okay, these areas right here had a large impulse to the upside and we reacted at these highs. So what I did immediately was on the daily chart, I marked out this area, right? Which is this is also called a demand zone, right? Demand zone just means whenever you have an impulse move to the upside, you look at the candle that preceded that impulse move that went in the opposite direction. So for instance, if we have a impulse move to the upside, let's say here, right? Just impulse movement to the upside. You just mark out the general region where you saw that occur or the consolidation that occurred before that. So if we had to do that same analysis here, you could basically draw out that entire region, right? So that was one point of confluence that it would continue moving to the downside when it closed extremely bearish on the daily chart. The second point of confluence was support lines. So support lines actually work arguably even better because those are such a basically understood concept in trading. And I love basic concepts in trading because everybody uses them and it's the one-on-ones of trading. So any bank or anything like that, it doesn't take a genius to say, man, if we reject it off here, most likely the most common area for liquidity is probably there as well. So that's what I love about simple concepts. So with that in mind, what I ended up drawing out for myself was this overall region on the daily chart. Anywhere here, right, was for me an area where I could say, you know what, the market has a really good chance of dumping towards these regions. And this was towards the mid of next week, of last week, sorry. So if you look at it, wherever the daily close, this opened up on the August, no, this one over here on the daily chart. I don't exactly know where it closed, where it opened, but basically this closed in, and I was thinking to myself, okay, cool. This is closing on the July 31st. And then right around here, I was thinking to myself, cool, the daily is closing. It's most likely going to go and dump aggressively. So this closed on Thursday. This was the close on Thursday. And then Friday opened up here and Friday dumped aggressively, right? So my analysis, I looked at it, said, cool, aggressive dump, high volume. We sniped beneath all these lows. This was like that initial low looked like it was going to move to the upside and it closed really bearish. This is to me not any area that I want to initiate trades off of. These are also called compressions. So a compression means whenever you have a lot of poorly signaled highs, poorly signaled lows, which means like a very compressed, choppy type of market structure like that, usually what you'll see is in most cases, it will either drop to the absolute bottom of that compression zone, or at least at the bare minimum to any of these regions here, you look for microstructure. So if you look at it here, it did some funny business, then broke to the upside. So this kind of a market microstructure over here. Anyway, simple put English, all I was saying is it had room to go down. Like these areas right here were nowhere near where I would say we would reverse up from. I was thinking we will definitely reverse at least to these resistance areas. And no surprise, what happened on Friday? We reversed exactly down to these areas. Exactly down to these areas, right? So now in
Yep.
my head, I'm thinking, cool, because we moved exactly down to these regions, what is my actual bias coming into this week? My bias coming into this week is we're most likely going to make a reversal to the upside, right? That's very logical to me. It aligns with higher time frames. It aligns with support and resistance zones. And there's another concept in trading. Nothing goes down forever. There are always going to be bounces before we move lower. So whether this be a reversal to the upside, whether this be a quick bounce and then continuation to the downside, it really doesn't matter to me. What matters to me is this is a good region. And if we ended the week super bearish, we are most likely going to come up and move to the upside. So that was my bias coming into the month or to the week. I am expecting this to move to the upside without a shadow of a doubt. Now, what ended up happening? We did exactly that, right? So we ended up coming up to the upside today. And here's the thing that I was starting to notice. And by the way, we're on extended trading hours. This entire analysis has been conducted on extended trading hours. I started thinking to myself, you know what, man? Let's now the extended trading hours is very powerful because you can understand like the overall context of the market, because futures are a 24-hour market, and we're not the only session that trades New York session, the futures market. London session has a lot of volume where all the UK based and the Europe based traders trade, and a lot of the banks in that area. Same with Asia sessions. So I looked at the extended trading hours for context. Now coming into the actual regular trading hours, these are the levels that we obviously mark out. We mark out these prior day highs and lows, right, that have not been closed through. Now on NQ, I didn't take this trade personally, but this was a very solid trade to take in general, right? If you understand the actual context. London session has a very nice high over here, right? So what ended up happening just before New York session opened up is we actually broke over here. I think there's a bit of a lag here, but we actually ended up breaking significantly above the London highs over here. So you guys can see that. You broke above London high, right? Which means now this area is usually seen as a resistance zone. You can take liquidity from it and move to the upside. So it broke that London high, and coming in with my overall bias that we're going to move to the upside, this in many cases, and especially with the way that I trade, I would have been very happy to take this off the open. So off the open, dead ass off the open. Market opens right around here. You see the overall context on the extended trading hours, which I would highly recommend everyone does, is you check out the extended trading hours before the market opens so you can see the overall context. And especially if you have a higher time frame analysis that's backing it, you can have a very, very strong analysis and very strong like bias that's actually pretty much more or less correct. And where would you actually enter these type of trades as it's breaking above these highs? And obviously there's a very wide stop for NQ. I wouldn't recommend you setting such a wide stop, but you can at least set it beneath that initial structure low over here, 60 pips, maybe 70 ticks to be safe, right? Right around here. These lows right beneath the London session high, and you target the next level, right? Because you're expecting a impulse aggression move on New York session open, Monday open, new start of the week open. So it aligns very well with when liquidity flows into the market. Now, anyway, I didn't take that trade, but that is something that I was looking at, and it's something that I would have taken, but would have, should have, could have. And what do they say? So anyway, on the 1 hour chart, what I was also looking at simultaneously, which the trade that I did take, however, was this one right here. The trade that I was looking at was very, very simple. Very, very simple, because when I looked at the actual 4-hour time frame, and I actually thought to myself, okay, where could the market hypothetically actually go, right? Like before it reverses potentially to the downside, because the overall higher time frame bias here is bearish, right? Where would we go? So for me, it was very simple. All I did is I understood that we had a strong impulse move to the upside. This general region right here, the same way I talked about that demand zone concept, you can also have the same concept in reverse, right? You mark out that low, that general region. This is like a pivot structure. It's also a 4-hour level. If you look at it right around here, it's like a 4-hour pivot swing point. Those things align. I was thinking to myself, most likely it's going to snipe liquidity there, because this just went straight vertical to the downside, right? I don't really see a reason to just randomly reverse over here. I would more likely expect it to reverse there. And it also falls in line with the bias that I had on the market, which is, there's a volume gap there. So at least to the volume gap, but potentially like higher. I don't know where. It doesn't matter to me. But it gave me enough confluence to say I can take a continuation trade to the upside later in the day. Because whenever you take trades later in the day, you want to make sure that your analysis is actually aligned with the 1 hour overall perspective, especially after 11:30 p.m., 11 a.m. Eastern time onwards. An hour and a half after open is when I start really being very critical over 1 hour closes. Now, the 1 hour closed with strong volume, right? Obviously, relative to the rest of the earlier part of the week, Sunday open, all the way to today, this was a very strong impulse move to the upside. So there was a lot of bullish momentum coming into the day. Now, that being said, immediately what you can also see on the 15-minute chart is it blew off some steam and it did 1, 2, 3, right? So it did 3 of those movements where it actually, let me just remove these boxes here. So it did 3 of these movements. So it bounced once. That's maybe a suspicious bounce. Second time, third time, off the level. So when I saw that second bounce, I thought to myself, okay, the market obviously could make a leg towards the upside, right? Because how do uptrends form? How do downtrends form? Let's just do a quick primer on that, right? If we assume this area right here on Friday was the downtrending area, right? Lower lower lows or lower highs, right? Then the break of structure switch would be right around here, right? And then the second area that would potentially reverse is right around there, but it broke through it. So where would the third area be? Right around here, right? So for me, that was my bias coming into it. So I had a decent shot at this being good. I wasn't, again, this is not like bet your house type trade. We are in the overall context against the market, but on the overall day, we're going with the market trend, which is bullish, right? So what I waited for was confluence. Whenever I'm trading later in the day, I want confluence. And if this is strongly opening, how do uptrends form? Well, very simple, right? They form higher highs and higher lows. Higher low, higher low. So on the 15-minute chart, when you see stuff like this indicates to you this is a higher low formation starting to form, right? So how did I enter the trade? Very simply put, I entered the trade not at the best moment, arguably speaking. I mean, it was decent, but it was not the best. It was like right around here, right? When I entered the trade, this 5-minute closed, set my stops beneath these lows right here, and I targeted high of day, right? Which would have been a 2.6R trade. Now, for me, one of the things that I've come to learn as well as a confluence symbol is I mark out, I don't use this too much as an entry signal, but one thing that I do like doing is the EMA, the 9 EMA. It's a very good trend following tool. So when you have a strong trend, oftentimes what you'll notice is whenever you have closes on the 5-minute, and arguably even over the 2-minute earlier in the day, you can see here was holding below, and then we came and closed above that 9 EMA on the 2-minute. Combined with my bias and my analysis that this is going to bounce on the 15-minute, that gave me more confidence to say, you know what, Matt, this is actually a pretty solid trade. So when it started closing above those 9 EMAs, I'm also thinking to myself, okay, you know what, man, like there's really no reason for me to like not take this trade and hold it. So ended up holding the trade, and I didn't end up holding it all the way to there. I cut 50% of my position here, right, when it did that first impulse move up, because you never know, it could reverse somewhere around here. So I didn't want to get chopped up. And then I ended up holding to the high a day as well, which perfectly lines up with where that volume gap actually occurs, right? These are unfilled gaps, very solid. Now it's obviously moving to the upside, but I encourage you to look at how did it move to the upside? Did it just randomly move to the upside? No, it didn't, right? It actually formed these kind of pivot structures before moving to the upside. So that's number one. Number two, notice how even the market as it's moving to the upside right now, what we're seeing is a very large gap, which also corresponds well to the theory that I have, which is whenever you have large gaps, it basically means you have less market activity over there, which typically means you have a lot easier of a time to snipe to the upside to the next relatively important gap, which, you could argue it's here. You could even argue it's way up there, but that's not my argument to make. I don't care. I would just hold the trade, like hypothetically speaking here, till somewhere there, assuming there was a level there, but that's not what I did, right? So that was overall the reasoning behind why I took that trade in the first place, and ended up being a well executed trade, especially once the 30-minute also started aligning with that analysis. And I ended up just cutting it high a day, about $37 across 18 accounts in this case, because again, I didn't link the initial ones, which ended up being a 2,400 and some change trade. May not be a lot of money relative to my usual days, but I'll take it, man. It was a good trade, and very minimal risk on it too. So that was a trade that I took, and I hope that absolutely helped you understand more of my thinking process around trades. Now, I don't use everything to trade. The VWAP's obviously nice, but I don't use it at all. And I don't use it often for these trading styles. I just use the system that we leverage, which is very simple. And yeah, I hope that makes sense to everybody. And I hope that you can help and use that to your own trading.